Hello and welcome to the first in a two-part webinar. My name is Christine Robinson and I work for BHP Chartered Accountants. With me today are Catherine Wilson and Lauren Pickard from Keebles LLP and Adrian Hume, also from BHP. We all work with large and small employers in all sectors, and we provide advice and solutions to many legal and tax issues that employers have to deal with, and they can range from anything to do with recruitment all the way through the working relationship and at the end as well. We came up with the idea for a webinar when we met and talked about what was happening in our work worlds right now. And in the run-up to this year's budget, we felt that there's a really strong connection with employment law and employment tax, particularly at the moment because of all the attention focused on workers' status. And it was really interesting, the different ways that we looked at the same issues. So here we are, a week before the proper budget, and we're going to be looking at some of the areas that we think are topical for employers. Adrian's been looking at electric cars. So over to you, Adrian.
Thank you, Christine. Well, hopefully you all recognise Elon Musk there in his Tesla that he sent into space in February this year. Obviously, he spent quite a lot of money doing that, and we're looking at more reasonable things in terms of company cars and taxation advantages of buying an electric car. So the advantage of buying an electric car for the business only really applies to capital allowances. If you decide to lease the vehicle, then there is no real difference between buying an electric car or buying something like a hybrid or a petrol or a diesel. If you do buy the car, you could benefit from 100% capital allowances. Now currently, this could change in the budget, you can get 100% capital allowance for buying an electric vehicle with a CO2 of less than 50 grams per kilometre. Now, if that's not quite in your budget and you want a bit more of a beastie car, then you could go for something up to 110 grams per kilometre, and that's going to get you just an 18% capital allowance. Above 110 grams per kilometre, then you're into the same tax regime as petrol, diesel and hybrid vehicles, so you're looking at about 8%. So that's really the main benefit of buying a company car that's actually electric. Well, let's have a look at what the position is for an employee. Well, first of all, does the employee actually want an electric company car? Is it viable for them? Can they get the kids in the back? And will it make it to the seaside and back? Now, one benefit of the Sinclair C5 was that if you actually ran out of juice, you could pedal it home. But I don't think you want your employees to be pushing your company cars all the way back from the shops. In terms of tax, employees are mostly focused on the amount of benefit in kind tax that they're going to be paying. The good news is that there is no fuel benefit with an electric company car. However, the car does come with the usual car benefit in kind issues. The car benefit in kind is calculated using two figures. First of all, a figure from a table based on the CO2. Now, the CO2 for an electric car or a hybrid car tends to be much lower than for a petrol or diesel equivalent vehicle. However, you also need to look at the list price. The list price for electric car, well, does depend on what model you're looking for. If you're looking for something like a nippy runabout, you can pay sub £20,000. If it's more like an e-Golf or a Tesla, for example, that could cost you up to £40,000 now. And if you're looking for something really nice, you could go for the electric Jaguar, but that's going for about £65,000. So overall, when you decide to buy the electric car, you do need to do the numbers and see what the tax position is going to be. The other thing that employers are very concerned about is actually mileage. Now, if the company owns the company car, then the employee can claim a whopping 4p per electric mile. If they happen to own their own electric car, then they can claim the usual mileage rates of 45p and 25p. Now, I'm not going to go through this entire table because, quite frankly, the rates and allowances there are probably all going to change in the budget. But this is just an example of how complex company car tax can be. So if you do have any queries, please do pick up the phone and give us a ring. So just thinking back to that spaceman who was in his car zooming around the universe, he's been up there since February. So by now, he's probably entitled to a bit more back pay. And as an employee, he'll be entitled to national minimum wage, which is something Catherine's going to talk about now.
Thanks, Adrian. Establishing a national minimum wage has always been very contentious, from the agreed rates payable by the Victorian mill owners to the 6 months a day paid to child labourers in the Second World War. Successive governments have aimed to strike a balance between the idea of dictating wage policy to employers and the need to protect some of the poorest and most vulnerable people. What is clear is that some sort of wage protection appears to be a permanent feature of government policy. And the latest incarnation was created by the Labour government and took effect from April 1999. This set an hourly rate of £3.60 for those aged over 21 and £3 per hour for those aged between 18 and 21. How times change. As you can see from the slide, the current figures are already well in excess of those figures. So what is likely to happen in the budget? Well, it's probably timely to remember that a certain Tory Chancellor, who now is running the capital's biggest newspaper, in 2015 proudly announced that the hourly rate for all over 25s by 2020 would be £9 per hour. So we can see that there is already still a significant difference. At the same time, the mood music continued in 2016 with the announcement by the government, much heralded, of the so-called living wage, of which more about later. However, in terms of the forthcoming budget, given this promise and the deficit, then further increases seem likely. However, it's not all about the rates, because at the same time as increasing those rates, government has already increased its enforcement activity with some startling results. In particular, I think it's noteworthy that as at the September 2018, some £15.6 million worth of underpayments affecting 200,000 workers and 600 employers were named and shamed. The employers were also fined some £14 million. So here are just a few of the main companies identified on the so-called Wall of Shame. Card Factory on this occasion came out worst, closely followed by Home Bargains, and coming in for very particular criticism. Beware your executive pay policy if you're found to have fallen foul of minimum wage. So the Card Factory was found to have failed to pay $430,000 to over 10,000 staff, whilst Home Bargains was held liable for $272,000 to over 700 staff. Behind the headlines and the bad publicity, however, it's not just household names that are identified. If we go back to the 600, then a number of those businesses were indeed these household names, but they also included a range of other organisations, such as bed and breakfasts in North Wales to Orcadian ferry companies. However, close examination identified some common areas where employers great and small had fallen foul. So I think it's noteworthy to start thinking about some of these. First area of concern was taking deductions from wages for costs such as uniforms. So for example, Karen Millen, the women's dress shop, received a staff discount on purchases, however still insisted that those staff had to wear Karen Millen clothes whilst they were working in the shops. A nice problem to have, you might think, however, fell foul of the minimum wage requirements. Similarly, expecting your staff to purchase black shoes, black jeans, black trousers, even if there is an element of personal use, led Wagamama and TGI Fridays also to fall foul of the legislation. Underpaying apprentices is probably a topic in itself, and it's something that Christine's going to talk about later. Similarly, failing to pay travel time, again, can cause particular problems. There is a specific exemption under the minimum wage requirements about accommodation. It's what we call the accommodation offset, which allows an employer to offset accommodation costs as part of the calculation of overall remuneration. This is not generous, allowing only £7 per night, so £49 per week. Misusing or misapplying this accommodation offset, however, can be very tricky. And it's certainly not straightforward, as going back to our slide of shame, the Marriott Hotels Group found. Another common mistake is using the wrong time periods for calculating pay, the so-called reference period. Under the legislation, reference periods are quite carefully defined by reference to salary payment periods, such as a week, monthly, 4 weekly, but in any event capped at 31 days. So why is this a problem? Well, for a number of our clients, particularly those involved in the leisure sector, there is a strong incentive to try and use a longer reference period. If I have a lot of seasonal business and seasonal workers where hours vary quite dramatically over the 12 months, then obviously I would prefer to use a reference period of 12 months to cover those seasonal differences. One can understand the attraction of that, but unfortunately that is simply not compliant with the legislation. And then finally, in this area, another area of complete difficulty has been the interplay between staff discounts and salary. So for example, if we look at the Stoke City example, staff were not only entitled to discounts on tickets and merchandise, but they could also pay for purchases via payroll, often over a period of time, which when analysed caused their actual pay to slip below the minimum wage requirements. So as we approach the budget, this is a timely reminder of the financial consequences of non-compliance, which are not only the full arrears of pay going back potentially to 1999, but also a financial penalty. And this penalty can be up to 200% of the arrears and subject to a maximum per person of 20,000. If we go back to our 700 staff employed by Home Bargains, one can begin to see quite how expensive such a failing can be. This is another area, indeed, where status, as Christine has already highlighted, is important, as an incorrect decision about employment status could also inadvertently lead to the non-payment of appropriate minimum wage. And this is something that Lauren is going to talk about in her section. So aside from the fact that wages seem likely to increase from April 2019, what else is new? Well, I've already hinted and talked about the 2016 change, which was the introduction by the Conservative government of the so-called national living wage. Good term. Unfortunately, this has become rather confused with the other well-established term of a living wage employer. They are different. And this slide shows the logo of the organisation called the Living Wage Foundation, which is not the same as the national living wage. There are a number of differences. Key thing is that the living wage is a voluntary payment and it's calculated on a wholly different basis than the national living wage. The national living wage and the minimum wage are calculated by reference to negotiation with employers, unions and other related stakeholders. The living wage, in contrast, is calculated by reference to real living costs, based on a basket of household goods and services. It covers all employees aged 18 and older, and indeed the only split is by location. It would be fair to say it is significantly in excess of the national minimum wage. So in London, it's an hourly rate of £10.20 per hour, and outside of London, it is £8.75 per hour. Voluntarily paid by 4,400 UK employers. And finally, aside from the rates themselves, why should employers be concerned? Well, we've already seen the increase in terms of enforcement, and government has already announced that the following specific areas will be targeted for compliance during the course of 2018 and 19. Social care, retail, commercial warehousing, employment agencies, apprentices and migrant workers are all very much under the spotlight. At the same time, there is a particular focus on gig economy workers, which again will be touched on by Lauren in her section. At this point, however, I'm going to hand over to Christine to talk about the practicalities of enforcement and how HMRC approach their task.
Thanks, Catherine. I found some interesting reasons that employers gave for not paying national minimum wage. This was on the Revenue's website because they're the government body that polices the national minimum wage. And if you look at these, I haven't done them all, but this is just a selection. Right at the top, it says it's part of UK culture not to pay young workers for the first 3 months as they have to prove their worth first. that obviously begs the question about trainees and apprentices. And there's another one there that I would say probably people might think that the apprentice rate should also apply. At the bottom on the left, my employee is still learning, so they aren't entitled to the national minimum wage. And this is one of the risk areas that Catherine mentioned, and that will definitely be checked by the revenue. The standby one, I just don't understand that one at all. As for the one about just making the tea and sweeping the floor as well, there's nothing that I can really say about that at all. But the one on the top right is probably one of the most common reasons that an employer will give, and that is that their workers are actually self-employed. And really, this is where we've got such a big overlap between employment law and employment tax and the national minimum wage, of course. So what actually happens if the revenue want to carry out a national minimum wage check? Excuse me. Like the rest of the revenue, they'll carry out a risk assessment and target those sectors known to pay their workers modestly. And Catherine's mentioned some of their named targets that are going to come up, that have already come up and will come up next year. But the revenue, it's important to know this, they will always follow up any kind of tip-off they get. So if you have a disgruntled employee or worker and they make an anonymous tip-off, that is going to be followed up. The revenue won't necessarily give you a reason why you've been selected for that visit. So you just need to be a little bit careful and make sure that you're following the processes that you need to. It's important as well to make sure that your payroll software works for you. So the first thing you're going to know about this is either a telephone call or a letter saying that you've been chosen for a compliance check. If you get a telephone call, I'm always rather worried about employers who get telephone calls out of the blue because of the potential for a hoax or a spam. And I know that these kind of telephone calls, there are spams out at the moment, they're automated. And they say that the employer has been prosecuted, that there's a warrant out for their arrest. Before you fly into a panic, please check into that or give us a call and we can look into it on your behalf. And don't feel that if you think the caller is actually genuinely from the revenue, don't feel that you actually need to speak to them. You must security check them first. And you can, there are ways to go about that. If you just give us a call, we can help you out with that. So let's say you've had your call and or your letter with the date on that you're going to have your check. You'll also be sent a list of the records that the revenue want to see, and they will typically include various reports that should be printed off from your payroll software. There'll be the actual payroll, but there will also be various things showing deductions from earnings. They'll want to see the letters that you get if you're making any attachments to earnings, any kind of deductions from pay that aren't tax and national insurance. You can expect to be asked to evidence that. Also important is to have the information to hand about the hours that are being worked, because that is a key part of doing the tax calculation, or the national minimum wage payment calculation, I should say. So if pay is made up from several components for different parts of your workforce, you should have all of that information to hand. Very important, you will be asked to produce employment contracts, particularly if somebody has got an apprenticeship agreement with you. The revenue will want to make sure that that apprenticeship is a proper apprenticeship and not just called an apprenticeship because somebody's fresh out of school and they're just learning and it's their first job and they're learning their way. So make sure that you've got that to hand. And the biggest thing that the revenue will then have to do is sift through all the people that you pay and work out who they're actually going to check, because we've got three categories of people who can earn. We've got self-employed people, we've got our workers, which is the employment law categorisation, and we've got employees. Now, national minimum wage is not going to apply to our self-employed people. It will, however, apply to workers and the full employees. What is the difference between these two? Well, it's a little bit subtle, I'm afraid. Both workers and employees will have an arrangement to personally do the work, but a worker may be able to send a substitute instead of doing the work themselves. And the employer doesn't have to offer worker work. So with an employee, I'm an employee. If I'm given some work to do, I have to carry out that work. I can't turn around and say, no, thank you, not today. But a worker has got that right to do that. So there's no expectation to provide a worker work, and the worker can turn that work down. Those are the main differences between a worker and an employee. But Lauren is going to talk about how you decide status between somebody who's self-employed or a worker and an employee, and she'll go into it in much more detail than I'm doing just now. So I'm going back to this check, this compliance check. I've mentioned about the apprentice arrangements. They're going to have to be checked to make sure that they're genuine. And the main errors that the revenue will come across, or they say that they come across, tend to lie with your payroll software. And that's where the payroll software, you don't get your update from your payroll software company. And so you're not uplifting the pay rates that come into force every April. But also, you haven't put in full information about your workers. So you don't have the date of birth there for your workers. So the software cannot make the connection that somebody's had their 21st birthday, and not only have they got a hangover, they're entitled to be paid more. So it's quite important to get those key data, that key data into the software right at the beginning, so that your software can do that bit of work for you. And similarly with apprentices, they get to be paid more after they've been an apprentice for 12 months, even if their apprenticeship will carry on longer than that. One thing quite interesting, it was talked about last Finance Act, but it is coming into play next April. From next April, employers are going to have to show working hours on the payslips, and that's so that the revenue can carry out the checks on national minimum wage payments easier than they can at the moment. Catherine's already mentioned the severe penalties of naming and shaming employers who get it wrong. I just wanted to point out, though, if you have underpaid your staff by only £100, you are going to be named and shamed unless you've got a very good reason why that shouldn't apply to you. So obviously this is a very, very harsh system, and it is policed by the revenue. And it's catching people who just simply make innocent errors. I'm going to pass on now over to Lauren, who wants to give you some more information about how you work out employment status.
Thank you, Christine. So I think we're all familiar now with the logos and cases on this slide. We have the Uber case, in which Uber drivers have been deemed to be workers rather than self-employed. The Pimlico plumbers case, where again the plumbers were deemed to be workers because they wore a uniform, drove branded vans, and had to be available for work for 40 hours per week. The Deliveroo case, in the Deliveroo case, Deliveroo actually settled before it went to the employment tribunal hearing, because despite the fact that there had been a decision by the Central Arbitration Committee, which was actually backed by the High Court, that the couriers were not actually workers and that they were self-employed contractors. So obviously Deliveroo did not want the risk of the employment tribunal reaching a different conclusion. The risk was just too great. It was better to settle. So we are seeing a whole myriad of different models of working, which further complicates the already murky issue of whether an individual has the status of an employee or a worker or is self-employed. The technological change that's been brought in has also introduced new ways of working, most notably in the gig economy. So we do have four or five main types of employment status still, and these are employees, workers, self-employed individuals such as consultants, agency workers, and a new type of worker, a sort of quasi worker. And these have come out of some recent cases where individuals have been deemed to be workers, but to whom PAYE just does not apply. And Christine's going to look at this further later. So why does employment status matter? Why do we need to get it right? Well, getting it wrong can have onerous consequences. Employment status affects the tax treatment of earnings. If earnings are treated incorrectly, HMRC can demand payment of the correct tax and employers' national insurance contributions, and this can be an unexpected and unbudgeted payment, which could be extremely expensive and burdensome for some employers, particularly if we're dealing with a large number of employees or workers. And of course, once HMRC is alerted to one issue, this could then lead to other in-depth investigations by HMRC, of which, of course, most, if not all, businesses would wish to avoid. Another risk area is that if an individual has not been recognised and treated as an employee or worker, then in all likelihood that individual will not have benefited from the same legal entitlements as employees or workers. This is a problem if the individual later realises this and issues an employment tribunal claim in respect of entitlements that they have not been afforded. An example of this, which applies to both employees and to workers, is holiday pay. If an employer treats an individual as self-employed when in fact they are a worker or an employee, then the individual would have the right to bring a claim for all of the unpaid holiday pay that they had missed out on, going back up to 2 years, because of course workers and employees are entitled to 5.6 weeks of paid holiday leave in each calendar year. Other reasons why it's important to get it right are that employers are vicariously liable, so legally liable, for acts done by their employees in the course of their employment. Employers also owe employees statutory duties relating to health and safety and are required to take out employers' liability insurance to cover the risk of injury to employees at work. So getting it right from the outset is important, and primarily it can save cash and management time in the long term. So if we're going to determine employment status, how do we do this? Well, the cases show that this can be tricky, particularly in certain sectors. A common misconception is that HMRC determines employment status for employment law purposes, and in fact it's the Employment Tribunal that will ultimately determine employment status, and it applies a variety of legal tests to do so. Avoiding those legal tests though and keeping it a bit more straightforward, there are several key factors that businesses can apply to determine whether an individual is an employee or self-employed, and these are mutual obligation. So as Christine touched upon, if the company has to provide regular work and the employee individual is under an obligation to carry out that work, so they cannot refuse to do it. Personal service, so employees are required to provide their services personally. They cannot just send someone else in to carry out their duties, much though I'm sure many employees would like to at times. Control, employees are under the control of the company controls what they do, how they do it, when they do it. You might be thinking that in the case of senior and professional positions, those people would retain significant control on how they carry out their work and sometimes when they do it, but yet they are still employees, and that's absolutely right. These tests cannot be taken in isolation. They really do need to be viewed as a whole and then a decision made. Exclusivity, so employees are not normally free to work for other organisations without the express permission of the company, and they might also be subject to post-termination restrictive covenants in their employment contract. Pay and benefits is another determining factor. So employees, of course, are usually paid a fixed amount on a regular payment date, irrespective of performance targets or completion of a specific task. They also usually receive pension and other benefits. Facilities and equipment. So the employer would usually provide these. Employees tend not to be required to bring their own equipment to work with them. Financial risk. Employees, of course, assume no financial risk in working. Taxation. Employees are not responsible for payment of income tax and national insurance contributions on their earnings. The employer makes those deductions on their behalf. And then, of course, the factors indicating self-employment status tend to be the exact opposite of those just mentioned, but just in brief. In the case of a self-employed individual, the company would not be required to or obliged to offer regular work, and the individual can, of course, turn work down and refuse work. The individual has the ability to determine when and how they work and is not under the direct supervision of the company. The individual can sometimes send someone else in their place to carry out the services. They're usually paid on completion of a specific task and provide their own equipment and materials. And they risk their own capital in the business, their own business, and are personally responsible for losses. And finally, they make payment of their own income tax and national insurance contributions on their earnings. Ultimately, each set of facts is going to be different. Because of the consequences of getting it wrong, it's always important that if you are in any doubt, to check with an employment lawyer. Looking at dual contracts then, this is an interesting concept and can create quite a headache for many businesses. The most common scenario that we see involves non-executive directors who are paid purely by their own personal service companies because of the perception that this would avoid income tax and national insurance contributions. This is hugely problematic for many reasons, but primarily due to the government's dislike of personal service companies and its recent strategy to tackle these within the public sector, requiring public sector organisations to decide themselves whether they think that they should be deducting tax and national insurance from payments to consultants. So ideally, a non-executive director would have two agreements. The first would be a letter of appointment or contract of service, that's contract of service, in respect of purely non-executive director duties such as attendance at meetings, producing reports and so on. The national minimum wage, income tax and both employer and employee national insurance contributions would apply to this. The second agreement would apply to consultancy work on a purely self-employed basis and would usually take the form of a consultancy agreement. A key benefit of getting the correct documents in place is that post-termination restrictive covenants would not usually be included in self-employed consultancy agreements, and we would not advise that this was included, as this would suggest an employment relationship, which obviously you want to avoid in that scenario. Whereas you can include post-termination restrictive covenants within a non-executive letter of appointment or contract for services, and we would advise that you do that. Moving on then, once you've determined employment status, this will be relevant to pensions auto-enrolment, which Adrian will now cover.
Thank you, Lauren. Well, I thought we'd kick off this segment with a little quiz. So, who does this monster belong to? Is it A, part of John Lewis's Next Christmas campaign? Or is it B, will it be a villain in the new series of Doctor Who? Or is it C, an employee of the Department for Work and Pensions? Well, given the subject matter, I'm sure you've all guessed that the answer is C. This, in fact, is Worky, who works at the Department of Work and Pensions. You may remember the auto-enrolment ad campaign that was running about 3 or 4 years ago. Worky was a big feature in the campaign, encouraging all employers to set up a workplace pension. Now, 3 or 4 years have passed since Worky started work at the DWP, and that means that you've auto-enrolled the majority of your staff, and they've been in your pension scheme for a good 2, maybe 3 years. That means that you're coming round to re-enrolment. So either this year or next year, you're going to need to be contacting your pensions advisor just to make sure that you've crossed the T's, dotted every I's on everything you need to do about re-enrolling everybody back into auto-enrolment. Now, as I said, Worky's been at the DWP for about 4 years. And when he started, his pension contributions were only about 1% for him and 1% for you, the employer. Well, DWP, the employer. You will have noticed that these rates have gone up over time. They went up in April this year, and unfortunately, they're also going to go up April next year. From April next year, the employee is going to be required to pay 5% into their workplace pension, and you, as their employer, are also going to have to add a further 3%. Now, these rates are compulsory, and there's not a lot you can do about them, but there is something you might wish to consider, and that's pension salary sacrifice. Now, salary sacrifice has taken a bit of a bashing over the last couple of years. The government have looked at it and gone, you know what, it's costing us a lot of tax and national insurance. So they've reined it in. However, what they've not reined in is pension salary sacrifice. They do see the benefits of operating pension salary sacrifice because it's encouraging employees to pay into their workplace pension. A pension salary sacrifice operates by an employee giving back part of their gross pay to you, their employer. You, their employer, then pay that over as a company pension contribution. And by doing that, the employee's not paid a pension contribution, the company has. They've crucially reduced their gross pay by X pounds. This X pounds will result in a 13.8% NIC saving for the company. As a general rule of thumb, look at your last month's payroll records, work out what employee pension contributions were paid last month. Now, if you divide that by 80 and multiply it by 100, that gets you your gross employee pension contribution. Remember, it needs to be the employee pension contribution, not the employer contribution. So this total, multiply that by 13.8%. That's the rate of employers' national insurance you're paying on employee pay. The result you get is your company saving. Now, you may be looking at the total in your calculator and going, you know what, that's not actually a lot. But think about it, it's just 1 month. So this saving is there next month, the month after that, the month after that, and it's just going to snowball over the year. Now, going forward to April 19, the auto-enrolment rates are going up again. So this saving is actually going to go up. And one of the really, really great benefits of pension salary sacrifice, not only that it's saving you national insurance, but it will save your employees national insurance, is that there's absolutely no effect whatsoever on the pension savings. Exactly the same amount goes into the employee's pension pot as it did beforehand. And now, over to Catherine for an explosive issue for employers.
No, you're not missing something. This really is a hand grenade. And in this section, I'm going to explain why. Settlement agreements and their predecessor, the compromise agreement, have been around for a long time, 1993 in fact, and there's no doubt that they have been extremely useful, enabling employers to settle statutory employment disputes with their employees. However, over time, as Chaucer first said in 1386, familiarity breeds contempt, and these superficially simple documents can pose a number of traps for the unwary. So after this, when you think of settlement agreements, think hand grenade. Superficially simple and perfectly safe when handled correctly. However, liable to be very dangerous, if not expensive for both parties, when not handled in the right way. Not settling the correct claims is a common mistake. However, the focus today is on the potential financial and tax pitfalls. So, first urban myth. Everyone is entitled to receive up to the first 30,000 of any termination payment tax-free. Well, in good lawyer style, not necessarily. HMRC explained to Parliament that the cost of this 30,000 exemption was approximately £1 billion a year. So you can see that it's an area that there is quite a lot of interest in. Key point to start off with is that there is no additional element for redundancy. What does this mean? Well, it means that you don't receive the first 30,000 tax-free plus your redundancy payment. The 30,000 payment is inclusive of any redundancy element. Now, as I've already said, clearly the cost of providing this so-called concession is quite significant. And perhaps in context, therefore, it's not surprising that since April 2018, there have been a number of changes, particularly in relation to the treatment of payments in lieu of notice. Since April 2018, these payments in lieu of notice are taxable and subject to deduction for national insurance contributions. This is irrespective of whether the pay in lieu of notice is contractual or so-called discretionary. But the agreement must identify whether the individual has worked their notice in full or part, and a failure to correctly identify the notice entitlement could well result in the entire 30k exemption being lost. Other threats to the exemption are attempts to sweep in holiday pay, bonus, commission within a global ex gratia settlement. Resist that temptation. Payments linked to employment are taxable and need to be identifiable as the same. Similarly, extra payments, such as new restricted covenants, confidential employment provisions and ongoing assistance provisions, also are fully taxable and need to be separately identified. At the same time, since April 2018, there has been a tightening of exemptions for personal injury claims and damages for injury to feelings, for example, in relation to discrimination claims. And similarly, those employees who've worked or spent some time abroad, again, their exemptions have also been altered. And if that applies in your particular case, you need to take specific advice. So what of the future? Do we see any further changes? Well, it would be nice to think that the 30,000 may be altered. I think the best estimate on real prices is that that would now be worth £71,000 as at today. Sadly, I don't think there's any enthusiasm in relation to that. In fact, quite the reverse. From next year, April 2019, employers' national insurance contributions extra payments, so a whole new charge, will also be payable on all the monies over 30,000. Hitherto, there has not been an employer national insurance charge, so again, could become very expensive in relation to those larger amounts. So what else do we think? Well, only to say it's very important to treat this area seriously. If you try and pull the wool over the eyes of the HMRC, it will be found out. More and more people are now filling in tax returns and being asked to disclose these settlement agreements. Similarly, if we look at payroll audit, again, settlement agreements is an area which is being looked at. And as we've already heard, the consequences can be punitive. So going forward, think hand grenade, take care. At this point, I'm going to hand over to Christine to talk about the extension of the IR35 provisions.
Thanks, Catherine. This lady is Krista Ackroyd, from Christina Ackroyd Media Limited, and she unfortunately lost her case against the Revenue. She claimed that IR35 tax rules didn't apply to her. The Revenue claimed that they did, and it went to tax tribunal, and she lost. That figure there of the £419,000 tax bill, that is the extent to which the Revenue can issue assessments for pay-as-you-earn tax and national insurance contributions if you are found that IR35 applies to you and you haven't applied it. So what is IR35? At its heart, it's all about employment status for tax, something we've talked about. Lauren's gone through all the questions that you have to think about in order to paint this picture and decide whether somebody is self-employed, in other words, in business on their own right, or are they actually an employee. So if somebody is giving you an invoice and asking to be paid on that invoice, it might be quite obvious that they are self-employed, they're in business on their own right. But what if they work for you and they invoice for that work through their own company? You've got an intermediary business between your company, your business, and that person who's doing the work, and that is their own company. That's called a personal service company, and the rules for IR35 were actually written to try and take on what the Revenue perceived was a problem with personal service companies. And the rules, which were written in 1999, asked you to pretend that your company didn't exist and to look at the actual working arrangements between you, if you're the director of that company, and your end client. And having looked at that working arrangement and run through all the things that Lauren talked about earlier, control, personal services, mutuality of obligation, and so on, if you consider that there would have been an employment between you, the worker, and your end client, had your company not existed, then the IR35 rules apply to that contract. And your company was asked to deduct tax, pay-as-you-earn tax, and national insurance contributions on payments into that company for that contract. So that is original IR35. In April last year, we had changes to IR35, and those changes applied to the public sector. The main change brought about by the changes to the public sector IR35 rules was that it was the public sector who had to make the decision about whether the IR35 rules apply. Now, the definition of a public sector has been taken from those who are affected by the Freedom of Information Act. So this will include dentists and doctors, not all dentists and doctors, but the vast majority of them, as well as some of these big household names there, and it will also include the revenue. So from April last year, if the public sector is the end client, they need to make the decision about whether the rules apply. But even if the public sector is using an agency to pay the personal service company, because there is the public sector being the end client or a client in this chain, the public sector company business still has to make that decision. If they decide that new IR35 actually applies, then what they have to do is to put the payment from the personal service company through their payroll for tax and national insurance, almost as if that company was an employee on their payroll. Even though they're doing that, it doesn't mean that the personal service company has become an employee with an employment right. So it's a really strange thing that's happened here. So what's my budget prediction? Well, this summer we had a consultation out, and the case was made by the Revenue to extend the public sector IR35 rules to the private sector. They said, as justification for it, in the information that they provided in the consultation, was that since the introduction of IR35 for the public sector, many, many more employees had been put through the payroll than before. They had noticed that there had been an increase in pay-as-you-earn tax and national insurance contributions that had been collected through the pay-as-you-earn system. And both of these things were helping to reduce the tax gap, and they still feel that there's a very large tax gap that still needs to be addressed, and they do feel that employment for tax purposes or self-employment for tax purposes is still not being dealt with correctly. So this is some justification why there is the idea to extend the public sector rules for IR35 to the private sector, and we're expecting to hear about that next week. Interestingly as well, the Revenue commissioned a survey of the public sector, and they asked how easy they found it to decide status. And the results came back, this was in the consultation document, that the public sector seemed to find deciding status very straightforward after some initial training. Well, whether that's the case or not, we're just going to have to wait and see until next week. But I'm going to leave you with an interesting case. A lady called Susan Winchester, she had her own personal service company. She's a marketing and business development consultant, and she was working for the Revenue. She worked through an agency, and the Revenue applied the new IR35 rules to her and put her payments through the payroll for tax and national insurance. And she took the view that if that was the case, then she was entitled to be paid holiday pay and also at the same rate that the Revenue pay their own staff. So she put a complaint to an employment tribunal, and the Revenue felt that they couldn't face that, and so they settled on the day out of court, and they have paid her over £4,000 in back holiday pay. We're going to finish now. I just wanted to let you know that part 2 of our budget webinar is going to be on Thursday the 22nd November at 1 o'clock. And if you have any questions, feel free to send them through to my colleague Lucy, and we hope to hear from you then. Thank you very much. Goodbye.